So, hi all, this is Akshara Menon from Famous Bazaar. A warm welcome to all the participants who have joined us today for the webinar on the topic Where to Invest Now, Navigating Indian Equities Post Elections. While talking this, we could see the markets have got their new highs today and having rallied back to the exit poll time, which was not the case during the election results. This shows how volatile the market is. With the new government in action, we need to more explore strategic investment opportunities in Indian stock market following the sectors poised for growth. Let's gain the experts' insight for effectively to navigate to the evolving landscape of Indian equities. For which we have Mr. Arun Subrahmanyam with us. Arun has over 25 years of professional experience in equity research and has featured as a top rated analyst in Institutional Investor and Asia Money. After graduating from St. Stephen's College, New Delhi, Arun qualified as a chartered accountant. He was last employed as Managing Director Research with Bank of America-Merrill Lynch, where he worked for 11 years before founding Ampersand. Arun strongly believes in fundamental equity research, and Ampersand's success is guided by the same principles towards investing. Before giving the podium to him, I would request the participants to put their questions in the Q&A box and not to ask any stock-specific questions. Over to you, sir.
Yeah, hi Akshara. Thanks for having me. I'll start with the presentation. Just give me a minute before we upload that. Thanks Akshara again. I represent Ampersand Capital. We are investment managers for a multi-cap scheme called the Ampersand Growth Opportunity Scheme. And as Akshara mentioned, the topic, of course, is about how to navigate the markets after the victory which we saw Prime Minister Modi take over office for the third time. So while this presentation obviously covers Ampersand, I've tried to shorten it and use a few slides to dedicate mainly for the topic in question. So we start with this thing about Modi coming back for the third time. A lot of strategists have already written on it, and we probably are a couple of weeks late. But our view, the day the election results were announced, they still remain the same. We haven't changed our strategy and our thoughts since then. So I'll talk about that later. So what we believe is that there was a lot of talk about the BJP trying to aiming for a very much higher number, and what will happen if BJP doesn't get that number. Well, frankly, as we've seen, it didn't really matter, because what we needed is a stable and stable government which provides continuity, and that is the most important thing for stock markets. And this is that's the reason why markets have rallied the way we have seen. In Modi 3.0, we believe that job generation and rural economy will be prioritized. Having said that, the thrust on infrastructure development will continue. And that is the takeaway we, at least, that's what we felt at the time of the election results being announced. And of course, macro indicators will also play a very important role in terms of how the market goes on from here. And we know that last couple of years we have seen a situation where rainfall was modest, interest rates have been very high, and we think that once interest rates starts to ease off, the full benefits of the economic reforms will start to play through. As far as Ampersand is concerned, we have seen, we have been around for 6.5 years. We have navigated through geopolitical events, a couple of elections, and we have come through all that. And we continue to believe that India is a growth economy, going to be a growth economy, and our fund is largely focused on growth. And we have this philosophy of how to invest in. As I mentioned, job recovery is the most important ingredient for this government, and they believe that they obviously believe that one of the reasons why they didn't probably get the mandate they wanted was the fact that there was a lot of talk on job creation and rural business. Over the last 5 years, we have seen, in fact, not just last 5 years, last 20 years, we go back in 20 years, the chart there shows that job generation has really weakened quite considerably, more so in the last 5 years post-COVID. And this, of course, has curtailed the re-election success rate and will no doubt be addressed on an urgent basis by this current government. We believe that job recovery will assist in revival of consumer demand, and it's not just the freebies which matter. That is the most important ingredient for a revival of demand. Like the previous government had already done, they had schemes like PLI and infrastructure construction. We believe that better execution of these schemes would drive in terms of better job generation. The second point is that we cannot ignore the fact that macros need to be favorable. It's not just about what the reforms do, but as we have seen the last 5 years, the government was constrained by a lot of events, both in terms of geopolitics as well as the COVID situation. But having said that, the government has navigated quite well in terms of maintaining financial prudence, which has managed to contain fiscal deficit. And inflation has been by and large in a comfort zone. And like I mentioned before, rainfalls we have a deficit in rainfalls until last year. This year promises to be much better in terms of domestic rainfall, and we are dependent on rainfall as we all know. Plus the fact that the US Fed has indicated that there would be a global easing of monetary policies. So by the end of the year, we do expect that to take off, and that will have a ripple effect on how our RBI governor behaves, and that could lead to acceleration of economic growth. We still feel that in this scenario, there will be revival in consumption, but a capex cycle is going to dominate as far as the thrust is concerned, given the fact that not just how BJP has shown its policies to be, and the new partner, especially Mr. Naidu, is also very pro-growth and quite capex oriented. That is something which we believe is going to continue. So coming to Ampersand itself and how we have actually constructed our portfolio. And I will not delve too much on the entire package of slides, but just the most relevant ones are what we are. Like I said, we are a multi-cap scheme. We are a managed multi-cap scheme, and over the last 6.5 years, our focus has been to generate superior performance and superior and consistent performance. Consistency is the most important deliverable for us. And to do that, we have gone about, we have used a mantra of choosing the right stock at the right time and the right size. So the right stock, obviously I'll discuss a little bit in the next slide, ideally is the one which, in our case, ideally is the one which where the management quality is paramount. It has to be up to our standards, which we believe are investable. Also, the business has to be attractive from a market point of view. I'm not talking about the stock market here. In terms of scaling up the business, addressable market has to be quite large, and the company should have a moat wherein it can actually be able to increase market share and scale up sizably. And that also obviously means that one has to have the trust that the company will be able to deliver on its strategy to grow. In terms of the time, I won't discuss more in terms of the timing and the size, but essentially what we try and do is we try and time a business cycle. The business cycle should be such that we get in at the bottom and exit at the top, which obviously doesn't happen all the time, but our decades of experience has given us some kind of confidence to monitor business cycles very closely, and that has enabled us to get into stocks at a very early stage. And we typically try and play the entire cycle if we can. And so we have a buy and hold strategy in terms of investments, and we believe that investing across a business cycle is the way to maximize your return potential. In terms of the in terms of the size, what we try and do is we try and construct a portfolio where the allocation of weights it's optimum. It's neither skewed towards it's not skewed towards a particular group of stocks or it has a very long tail. So the allocation is based typically on what we believe, which companies we believe have very strong growth outlook. At the same time, they are balanced by risks in terms of business volatility and stock market liquidity. So our portfolio, which I'll come to later, is very low on micro caps. In fact, we hardly own any of the micro cap companies because of the liquidity concern and also the high impact costs. And also, like I mentioned, that we don't have a very skewed portfolio. We are well diversified. So while you may have seen certain sectors or segments do extremely well last year, but still, despite not having a very large presence in those segments, we managed to deliver very strong growth. As our mandate or our scheme suggests, we typically try and identify growth companies. And we believe that growth will be the key driver of stock prices. And going forward, it was a combination of growth and valuation re-rating. Going forward, we think that valuation re-rating is possibly has very limited scope, given the fact that several sectors are already trading at premium valuations. So growth is going to be the key parameter for delivering, continuing to deliver the performance which we hope to. In terms of how we choose stocks, we are macro cap, we are market cap agnostic, and we try and invest in stocks where valuations are reasonable. But at this point in time, what is reasonable? Well, either you don't get anything reasonable, or you get something which is not so reasonable, but where the growth prospects are very exciting. So we typically try and balance the two and invest in such companies. Coming to the themes which we like at the present, and it's not just because of what has happened in the last month or the last 6 months. We have been focusing on these themes over the past year or so, and we just the fact that we now have a situation where there's clarity in terms of which government is going to be actually running the country. We believe that it has kind of strengthened our need to stay in those themes. And the three themes or three sectors we are largely focused on. One is energy transition, and the second is premiumization. And thirdly, in terms of companies which are dedicated towards technology and research. So I'll briefly discuss these three segments along with some companies to give you an example of which kind of companies we actually try and target. It's not that we own all these companies which I mentioned there. We have ownership in some of them, but these are just examples to illustrate what we like. So in energy transition, we know that India is getting into a huge deficit in terms of, and we have underinvested in this segment for decades. And we are obviously seeing a significant investment coming back to the sector. So either you play it through the utility companies or the power generating companies. But we think the better way to play it would be through the ancillaries or the power equipment companies. And this is what we think can generate the alpha. Some of them, obviously, the names which you've seen here and have already done that. But we believe that there is a lot more to go as we move forward. And these companies, in our view, they have a long visibility in terms of growth. When I say long, it could be anywhere between 3 to 5 years. And we believe that earnings growth can typically be 20 to 25% or higher. And so while these companies have delivered very strong returns in terms of the stock performance, so like I said, re-rating may not be the key driver for stock performance going forward, but I think earnings growth will be able to deliver the similar kind of returns as far as stocks are concerned. The second theme which we like is, we actually call it a theme because you can either go through sectors and buy individual stocks within those same sectors, but within those sectors, we have preferred the theme of premiumization, which we believe can deliver, not only can it deliver superior growth, but it also can deliver 30% plus kind of ROCs. And that in some sense justifies the valuations of many of these stocks, which already are trading at reasonably rich valuations. So premiumization is a theme which you can see across sectors. It could be in hotels, it could be in online portals like the Zoom. Sorry, not Zoom. Sorry, Zomato, and also hotels like Indian hotels and East India hotels. You can also see this theme play out in segments like energy drinks, like Varun Beverages. For example, Varun Beverages was earlier a typical franchisee owner of Pepsi, and that when it transitioned to the Sting energy drink, that is where you actually saw a lot of growth coming through, and that is what actually re-rated the stock as we have seen it in the past couple of years. We also like the premiumization theme in fashion retailers like Trend as well as Notos. There are lots of companies. We know that iShare is a pure premium play, but not just that. We have companies like Mahindra and Mahindra, which have actually which always used to make SUVs, and that is a segment which has done incredibly well within autos, and Mahindra has obviously been the dominant player that increasing its market share. Finally, coming to technology and R&D plays, we don't have AI-focused plays in India, but there would be over time there would be companies which you can get into, which typically would be vendors to some of the large IT companies globally. So we have some of those names mentioned in our list. But the segment we like more is the contract research and pharma companies. So while pharma as a play is looked at as a US generic play or in terms of domestic formulations, the theme we like more is the contract research. Contract research companies, which have the advantage of having India having a large pool of scientists, and these companies having the wherewithal to supply drugs to the innovators in the US and elsewhere. And there are some specialized engineering companies also, again, playing the same theme, which can be suppliers to global companies like Elecon and Jyoti CNC. Again, like I said, it's not that we own all these companies. Some of them, of course, we have invested in. I've already spoken about the power deficit situation and how capex is going to be driving growth in this sector. So this is just an illustration of that. The slides typically show how the power sector has been the dominant segment in terms of driving the capex theme in India. Likewise, I think I've already discussed all of this in the previous slide, but just an illustration of how these segments have done in the past few years and why we like the sector. Coming to our portfolio weights, the reason actually I've put this slide here is because the weights you see here were very similar. We were there before the election results came out, and they continue to be very similar to as we speak to you today. So our biggest weights are in the industrials, which are all these capital in goods and engineering companies. And in fact, we probably have increased weights there slightly. And then the consumer discretionary is another segment where we have a large exposure to. What is also notable here is that we have weights which are higher than the benchmark. And within our portfolio, they are the two most invested themes or sectors where we have allocated the capital. There are other segments we have invested in, just to illustrate again that our portfolio is reasonably diversified, like in terms of having certain financials. We just have one bank. Most of the financials are actually focused on companies like wealth management companies or the exchanges and things like that. So we have played the other sectors mostly through a bottom-up ideation. I don't know I don't know how much time I've spent, but that's all I have in my presentation. I just kind of tried to shorten it so that I leave questions to both Akshara and my viewers, so they can go ahead and ask me questions.
Thank you, sir. So my very first question would be towards, of course, about the markets. Like, despite the challenges that we have in Modi 3.0, and which looked like a bit uncertain in past few days, and the market has also recovered from their lows. But it will be smooth. But it doesn't be smooth, right? So, what are your general views on the market?
So, if you had asked me this 2 weeks ago, and I don't think I would have changed my answer. But markets have actually surprised us in the sense that they've actually risen more than we thought it would. But we knew that markets would do well, especially for the reasons I've already mentioned. It's all about having continuity and the fact that the markets were in some way positioned that all this talk about BJP getting 400 seats and things like that, and I don't think that really mattered. The fact that there was an event which was over, and the markets kind of heaved a sigh of relief, and you had the people who were sitting on the sidelines coming back and obviously getting it back to the market. As far as the markets are concerned from here on, we do think that the markets will continue to do well. But like I said, the pace actually has surprised me a bit. We could potentially see some hiccup towards the budget, where the budget may not deliver if the markets are still extremely in euphoric state. We may not see that immediately. So you could probably potentially see some correction, and that would again be an opportunity to buy. Not that we are saying we should not buy it today, but today, obviously, increasingly, it's getting to a situation where you have to be very selective. So either you hold on to what you hold or what you already invested in, or you try and selectively buy into stocks which you've actually missed out on.
When you say that, FIs were net short in their run up during the election results. So, what are your views on it now?
See, FIs are very difficult to actually, currently part of the trade probably obviously has happened because the FIs have covered their shorts, maybe. But the fact is that most of the rally has come in because of domestics and retail. That's what's actually driven the rally. As far as FIs pouring in money, that's still not really happening the way you expect them to, and that won't happen till this whole global interest rate scenario starts to change, and that's when actually you will see money moving out from developed economies to the emerging markets, and then emerging markets, depending on which economy at that point in time is looking more attractive, and that's the economy which will probably get more money. In the last 6 months, FIs have actually taken money, have invested outside India. They've invested in China and places like that. So it's not that they have not invested in the emerging economies. It's just that they found India quite expensive, and they felt that there was an event in play. The event has gone. India has not got cheaper, so at some point in time they will obviously come back when this global interest rate scenario reverses.
When you say the event has concluded, so do you anticipate any kind of market corrections in near future now?
Yeah, which is what I said. It's very difficult to say if markets are going to correct next week or next month. And I'm just playing out the events which are going to happen in the next month or two, and the only relevant event is the budget. I mean, other than that, I mean, we've seen everything happen. You've seen the elections happen. You've seen the portfolios being assigned. The rainfalls have started okay. So the only event which is left to speculate on, so to speak, will be the budget. So which is why I said that could be potentially a point where markets could start getting a little jittery. But I don't think that correction, if any, would last very long.
So when you talked in the last before slide was you were talking about the sectors that Ampersand is bullish on. So which sectors do you expect to do well in this current new administration? Like recently we could see FMGC and IT sectors have gained their momentum. So what are your thoughts on this trend?
So FMCG is something which we have not really, like I said, we played FMCG very strangely through just just a couple of names. And in fact, one name I've already discussed in the slide presentation. We've only invested through that, and we continue to actually be very bullish on that. But FMCG as a sector, we don't, certainly that sector will see better growth because of the fact that there will be a better rainfall. There will be hopes of the economy coming out of rural distress, and also some of the FMCG companies which are highly dependent on crude derivatives as their raw material, they will start to benefit. So FMCG as a sector could potentially do well, but whether they will do whether whether they're investable or whether they're not going to be sectors which can deliver growth year on year, and I'm not talking growth. I'm talking about really strong growth. Strong growth will still come out of ex FMCG sectors, and that's what segment we like. We think the better way to play FMCG or the consumer in general would be to play the discretionary, where you will also have the benefit of softer interest rates going forward. So you either play to the discretionary, or you stick to playing these structural growth themes like capital goods and industrials. So those are the two pockets where we are heavily invested in, and that's why I said in the beginning itself, we haven't really changed our strategy. Of course, if things had turned completely contrary to our expectations in terms of the election results and all that, we would have had to really rethink on how to position ourselves. And that's not happened, so we don't see any reason to believe it otherwise. And coming to IT, since you asked me about, I'm very sorry. Yeah. Since you asked me about IT also the same problem. Yes, IT will start to look up when this interest rates in the US start to come off, and it's viewed more as a kind of a play where interest rates are coming down in the US, and then you focus on IT. But IT also has other problems, right? I mean, it has problems of competition from AI and things like that. So again, they would at best be small trades, or if not small trades, at least short cycle returns. They won't be extended cycles like the ones I mentioned.
Now that we're talking more on sectors, let me take one question from the audience. Is that how do you see PSU sectors? Do you have any allocation to PSU stocks?
So we have very little allocation to PSUs. But having said that, I'm not anti-PSU or anything of that sort. The reason why we didn't invest in PSUs, despite the value which was quite evident, was simply because we felt that they don't have extended cycles, there's not much surety in terms of what a PSU will be subjected to in terms of government regulation, and that's the reason why we really didn't put money in PSUs. We do have one investment, which is a PSU, a complete PSU, but that is also because of the fact that it supported the power sector theme, which we were bullish on. That's why we invested in it. We also have one play in the railway space, which is not a PSU, but which supplies to PSUs. So in that sense, it is dependent on PSUs. And these two companies have done enough for us in the last 1 year. They've given us. They've been multi-baggers. So it's not necessary that you really have to have a very skewed allocation to PSUs. You still can do well by having some kind of portfolio which has a little bit of PSU, a little bit of defense, or things like that. And but you focus on your core themes, which, like I said, continues to be capital goods and consumer discretionary.
So next question, we also on more like on sector. More like you should choose one. If which sector would you prefer, consumption or manufacturing?
You want me to choose only one?
Yeah, that is a question put by Neha. If you were to choose one, what would it be?
Okay, see, it all depends. Consumption is a great place to be in because there are so many companies. I mean, the whole space, you have lots and lots of companies, and you can. So while our preference so far has been towards the manufacturing space, it is possible that we would shift some of that to consumption. So like I said, I won't say that I prefer consumption over manufacturing, but I would say that incrementally that is where probably we would put our money in. Because we are very well invested in the capital goods space, and we may not increase it to the levels which we will then start feeling that we are skewed towards one sector and not the others.
I'll take the next question when that revolves around the sector theme. So it's like defense theme is really doing well, and valuations of defense company are relatively higher in short term. Will this trend possibly continue in upcoming months?
So it's a very difficult call. I mean, it's obviously a multi-year theme, right? And that's what the market's actually giving the benefit of doubt. And last year they did it to the PSUs, which had value. Now they are actually trying to look at the some of the private players, which actually don't have any value. But there is an expectation that since their execution capabilities are better, so they will be able to deliver growth and they will command very high valuations. As a theme, I think it will do well. But again, you'll have to be very selective because stocks have done so well. There's so many stocks have done well that you really have to. If you're holding on to something, you might as well you continue to hold on to it. I don't think there's any reason to exit. But if you don't have anything, then you have to be very selective in where you get into.
So when you talk about the market volatility now, is it an appropriate time for to reshuffle the portfolio? Like if so, what would be the ideal market cap allocation would you advise an investor?
See, reshuffling is fraught with danger in the sense that, see, first of all, it's not very efficient tax wise. I mean, if you keep doing that, I mean, you end up paying taxes and then you get into something which may have a very short run. If you believe in certain sectors which you have invested in, like I said, I don't think anything has really changed materially for you to actually reshuffle your portfolio. If you had a certain mix of stocks prior to June 3rd, I don't think the mix should dramatically change. You can do tinkering to your portfolio where you feel that you've been grossly underweight or you're missing in certain sectors. Like I said, consumption is a sector where people were grossly underweight. So obviously and you obviously have seen some of that play out in the last couple of weeks where some money has shifted there, and they will potentially do well. At least that is an expectation that whole consumption theme will play out in the coming year. So you can do the tinkering if you depending on how you're positioned. But I don't think a major reshuffle is warranted. I mean, I'm talking from my point of view, so I don't know who's holding what.
So what is according to you, what is your ideal investment horizon for an investor to stay invested in this particular fund?
See, we are a long only fund. If you look at this last month and a half, we have churned our portfolio a bit. It is not because of it is partly because of the fact there was an event and we felt that sectors we had run up a bit too much. So we just lightened it a bit, not very significantly. And we did that whole thing about shifting to consumption, not knowing that this event is going to play out the way it did. But having said that, I'm sorry, I missed your question. What's your question? Sorry, what did you say?
What is the ideal investment horizon for this particular fund? Yeah.
I'm very sorry. Yeah. So see, our investment horizon is we are long only fund. So we typically try and invest in companies at least for 3 years, which sometimes doesn't happen. It may not happen because of the volatility which occurs due to the geopolitics which has happened in the past couple of years. It may not happen also because of certain things which are completely outside your control. But by and large, if you look at the stocks where we have actually made money, they have been stocks which we have held on since prior to COVID. Yes, there are certain themes which actually played out very well for us, which we invested 15 months ago. But that has turned out to be momentum much faster than we thought. For example, defense and themes like that have played out much faster than we thought. We never expected that to happen. We would typically, therefore, although our horizon is 3 years, there are certain themes which we believe when we think that stocks have really run ahead of where we expected them to. We would look to probably prune down our holdings, but I don't think we'll exit those names very soon.
Okay. When you say all the long only portfolio, so what is that exit strategy that you use for this portfolio?
So I had not shown that slide, but very briefly. See, what we try and do is to play cycles. When I say, so you essentially need to buy companies which you believe are at the bottom or close to the bottom of a cycle, and then ride through the entire cycle. So it's very difficult to time this. So we may get it wrong sometimes. We may be 6 months early in some cycle, or we may be probably 6 months late. As long as you believe that the cycle is going to play out for more than 3 years, you're okay. So that's typically what we would do in terms of when to buy or when to exit. So the question was on exit. So
Yeah,
we
it's
don't really typically try and exit unless we believe that either the demand situation or the margin situation has peaked. So unless that happens, we continue to try and ride. But it's not that we have not made exits earlier. But like I said, explained to you, some of these exits we do make when we believe that the valuations are completely out of sync.
So when you say when it's a long only portfolio here, and that is an disadvantage of not having an option of short selling thing and not booking the
Yeah.
profit. So this
Yeah.
is a risk for the time. So how do you manage this?
So, like I said, it's a risk and an opportunity because the thing is that it's a risk because there could be events which you can't anticipate, and you cannot, since you cannot short sell, you just have to, you can only wait if the stocks, if markets come down, you only option you have is to buy. If you have cash, then you go ahead and buy. That's what we do. But like I said, the problem is that you cannot really strictly compare a long only with another portfolio which is active in terms of short selling or hedging, because like I said, it's not a very tax efficient way of generating wealth. I mean, the longer you actually hold on to stocks is the more you generate. It's, yes, you may lose out those short term
Profits.
movements. That's possible. And it's happened to us. I mean, the last couple of years we've had those events. But it all depends on what kind of stocks you own, and how you're positioned. So I had mentioned also that we don't really own any microcap. We just don't have any microcap. And like I said, it's not that we can't invest in a microcap, because we feel that those are segments where we really don't know. The impact cost is very high, and if you have certain events like you just mentioned, then we really don't know what to do when that situation arises. In fact, if you look at our portfolio is I don't know whether you're going to ask me the question. I might as well tell you, but our portfolio is typically 40 40 20. 40 is large cap, 40 is mid cap, and 20 is small cap. I'll get to the definition of small cap and large cap in a minute. The large cap does not mean Nifty stocks. It is mostly the junior Nifty. These companies like foreign beverages, and those names, those large those Nifty, the Nifty Juniors. Nifty Junior is where we have bulk of our holdings. Those are very large companies, and where the growth prospects are very much more exciting than some of the Nifty stocks. And coming to the small caps, our small caps are typically, like I said, we don't invest in micro caps, but we do invest in small caps, which we believe can become caps in the future. I'll just mention a couple of instances. I'm not saying we hold it, but for example, a TVS Motor. I mean, 5 years ago it was a small cap. Today it's actually comparable to a large cap. I mean, not that I could forecast it 5 years ago, but those are the kind of companies we try and invest in. Small caps which can become large. But if you look at the bulk of the small caps today in India, they are not small caps which have the potential to become large. That universe is very, very small. Most of the small caps are focused on commodity. They are basically commodity plays, or those who have very short cycles. The chemical companies, or the some of the iron ore and metal companies, where the cycles are very short, and it's very difficult for one to understand and invest in those companies. So we typically invest in small caps where there is a potential of the company scaling up to a much higher level. So I know this is a question you didn't ask. I just went on extempore. Anyway, sorry.
No, I understood that. So when you say it's 40% of large cap and 40% mid cap, and only 20% you've given to small cap as an allocation. And the second biggest risk I would see in long only portfolio is liquidity. So how often do you take cash?
Okay, so like I said, our portfolio, the way it's actually been structured, liquidity has not been a problem. Having said that, there are several mid caps who we call traditional mid caps, which are extremely illiquid, right? I mean, they could have market caps of in excess of 50,000 crores, but they're extremely illiquid. So the way to do it is obviously to try and diversify your holdings to some extent. That actually helps. Because not only does it help from a sectoral point of view, but also helps from a liquidity point of view, because you really don't, what you do is, instead of having very large positions in certain stocks, you spread it across two names. So and so that it becomes a little easier to manage liquidity. As far as cash position is concerned, we have never had very high cash positions. In fact, it's been very, very low. Currently, our cash position is high, not because we have sold, but because we've got a lot of inflows, and that's why actually our cash position is slightly high. But we typically try and keep because there's so many ideas, and we invest only in 32 names, and we can't. And every week potentially we can get through. We research about 200 to 250 companies, and it throws up so many ideas. But we don't try and invest in every. We obviously can't invest in every name, but we try and limit ourselves to the 30 or 35 names. So that's what it is. I mean, we try and reinvest whatever cash we get in the stocks we already own, or we wait for the opportunity for stocks to correct and then take a call.
Okay. So your growth opportunity fund, which is a CAT3 AF, and it's a long only. So how does that different from any other PMS apart from this minimum investment?
So, well, one big difference which I actually told you, which is you didn't ask me the question, but I just told you that a lot of the PMSs. I don't think there obviously are PMSs which are focused on small caps, and some which are focused on. We are first of all, we are a multi-cap scheme, and there are very few. I think there are. I won't deny it. There are a few multi-cap PMS schemes, but we truly are that, and that is something which we believe is kind of differentiates us from most of the other PMSs. I don't know what else I can think as a differentiating factor, because AIFs, there's obviously the fact that the tax is paid by the fund, so the investor doesn't really have to bother about the tax situation. PMS, you have the situation where tax is frequently tax has to be paid by the investor, and that could result in certain kind of tax inefficiency. But other than that, I don't think I can really differentiate between a PMS and AIF. And of course, the fact that the entry barriers are there. The PMS, 50 lakh is the subscription amount, and we have 1 crore as the minimum subscription to start with. Other than that, I don't think there's anything I can differentiate with respect to the two different instruments. Different schemes, different PMSs, different AIFs have their own strategy on how to invest in the stocks.
One question: what is your USP? Like, why should one opt for your house instead of going for big names like ICICI and others? So how do you differentiate Ampersand from them?
So, I won't talk about competition, because you just took one name there. They're not just one; there are hundreds of them. So, see, our background. I mean, you just introduced me as the founder. I mean, my background. I mean, I've been a research analyst for 23 or 24 years on the sell side. So I was never in the buy side. Most of the buy side fund managers, they actually started their own PMSs and AIFs. And so to that extent, they had the experience of running a fund. But having said that, what differentiates us is that we are very, 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 very research oriented. We both, me and my colleague and the couple of analysts we have, we focus completely on bottom up research, and we just don't look at stocks beyond. We don't look at momentum. We don't look at stock ideas which has been told to us by our friends or others. We try and do our own bit and see where we can master that understanding of the particular company. Our hit rate has been reasonably good. I mean, obviously, we missed a lot of companies, and for the reasons we already mentioned to you. But given the fact that both me and my colleague have had decades of experience in understanding how to research companies, and we have done a plethora of sectors. I mean, I used to be an auto analyst, also a pharma and healthcare analyst. My colleague, who's not there here, but he's done a plethora of sectors. He was actually a mid-cap specialist and also a very well-recognized mid-cap analyst. And used to cover sectors like cement, auto anchs, and things like that. So we have a lot of experience, wealth of experience in terms of understanding sectors, and that's actually probably what differentiates us from the others.
Yeah. When you say that you research more on autos and capital goods, as you said, no, is that the reason that you're bit biased on these sectors like autos,
No,
capital goods, and consumer
no, I was
space?
never. Okay, I was never in. No, I was never against capital goods. I said autos. So capital goods is something which was I had no background of understanding it. My colleague had some, because again, not because he was a capital goods analyst. He was actually a mid cap analyst, and he had looked at these companies when he was a mid cap analyst. Those companies have now become as big as large companies. That's a different matter altogether. So we have understanding of a lot of sectors, and we are, like I said, one of the slides, we are both market cap agnostic and sector agnostic. So it doesn't really matter where we invest, as long as we believe that these companies have a common feature of delivering strong growth and have a very good balance sheet, very managed well, high ROEs. Those are the companies. I mean, obviously, you would have heard this from many fund managers that they do the same thing. But we do it because we have done a lot of sectors, and other than that, there's nothing else. Like I said, I can actually support my argument.
Understand, sir. So, if you could give us an example of your past investments, suppose it underperformed, and what are lessons that you taken from it?
We have been around for 6.5 years. So I won't go back to what happened 5 years ago. So I'll say one of the more recent investments. We invested in a company called PI Industries, which is a very good company, mostly, I mean, in the CRAM space, and extremely well managed, and they have a very strong track record. We invested in them about a year and a half ago, 2 years ago. Company continued to deliver numbers, but the stock didn't do well. It has, I mean, we obviously exited after a year and a half, but and we did make some returns. But what we learned is that it was a company which had kind of topped out in terms of its growth trajectory, and there was a high concentration of a few clients, and that is something which we probably misread. Having said that, I don't think this company has. It obviously has a very strong DNA, and it obviously bounced back. I'm sure, but we got the timing wrong. We didn't make money in that, and so we obviously need to. We actually reflected on this and said these are kind of mistakes we should not make.
Understood. So, like when we
And
now
there,
that we
and, there, and there are lots of mistakes we've made in terms of not buying certain stocks because they've done very well and we don't own them.
so now that we spoke a lot on the fund, let us talk more on the returns part as well. So you have been in this industry like last mean this fund has been in the industry for let's say last 6 years. So if you could elaborate more on the returns part of it.
Somebody who had invested in us at the beginning of our fund, which was in September 17, their returns would have been 4x plus by now. But then people will question that, oh, you had this period where COVID, you did very well, and then you had 2023 where you did very well. But what we have tried to do, and we've been partially successful, is to deliver consistent performance. So, for example, even the year 2018, which was a very poor year for most PMSs and AIFs. In fact, we not AIFs are mostly close-ended AIFs in 2018. We were one of the very few open-ended AIFs that time. But I remember that is a period where SEBI made this change in terms of market cap nomenclature for market cap classification, and mid caps and small caps did very, very badly. Even that year, we managed to generate single-digit returns. So we've actually been reasonably consistent. And the COVID year, I mean, from bottom of the COVID cycle for the next 12 months, a lot of PMSs probably more than doubled their money. We didn't because we didn't invest in as much in the chemical companies or the commodities, and we still don't. We didn't do as well as the others, some of the others did. But what is important is in terms of being very consistent, and that's what we've actually managed to do reasonably successfully.
Okay. So if there's a sector which has been valued high, and being in a long only portfolio, do you either give do you do you give weightage that overvalued sector, or do you completely avoid them? What is your approach towards
So you're asking me, do we
sectors which
invest in
is highly
sectors
valued?
highly valued? So see, ours is a growth focused fund. If I say growth at reasonable price, it's something which has been said by everybody. So I don't want to say that, but I would like to say it in a different way. See, we invest in growth irrespective of what the valuations are. I should say irrespective, with our eye on valuations. So we there are lots of companies in our portfolio which are highly valued, but they were highly valued when we invested, and they are probably even more highly valued as I speak to you today. But the reason why the valuation has re-rated further has been mostly because there has been an upside surprise to the growth the company has managed to deliver. Obviously, as analysts, when you believe in certain company or certain sector, you project or you perceive a company to grow at a certain rate or sector to grow at a certain rate. If there is positive surprise to that, if they do that, stocks will do well. But if there's a positive surprise to that, so even if the sector or the stock is richly valued, the sector or stock will tend to get overvalued, or let's say more richly valued. And so we don't avoid companies because of valuation. What we avoid, but we do avoid companies where growth is missing. So when we feel that growth is missing, not for now, growth will be missing for the next couple of years, then we try and not try. We don't typically don't invest.
Now that we know you and your product, so if you could explain your team so that our audience will have a great connect to the
Sure.
AMCS.
So we are actually very thin. We are a very lean team because we do a lot. We do everything. I mean, except for the very rudimentary jobs, which are to be done by people whom I don't want to mention, but we do everything in the office. So, but basically, I double up as both the portfolio manager and the analyst, like my colleague. My colleague also does exactly the same thing, and we have decades of experience. I have more than 3 decades, and he has more than 2 decades. So that's it. We also have a couple of research analysts who are qualified research analysts, and they worked in firms before. So we have to. So a team of 4, which we think is enough to track. Who have tracked, by the way, a team of 4, of which 2 of them have. Two of us have tracked several sectors and several companies for decades, and a couple who are starting off and learning the job. We think is enough to cover the top 200, 300 companies, and that's the kind of list we maintain. That's the list we maintain and track quite diligently. Yes, time will come when we'll probably say, no, we have to look at more companies. There are more companies which are exciting. Some of our companies are getting into a mature phase. So we'll obviously look to add some resource. But at this point in time, I think we are good enough to manage the 200 to 250 company portfolio of 200 to portfolio. Look at 250 companies and invest in about 30 35 names.
So now the question comes in the skin in the game. So how much is your personal capital of you and your team have been invested in this?
So me and my team. So I don't have the exact number, but I will just give you a hint. Not a hint. I mean, I give you a kind of approximate number. So when we started the fund, a lot of money was ours. I mean, more than 50% or 60% was ours. Since then, we have not divested anything. But because of these, because of newer investors getting in, that proportion has come down. So now it will be less than 30%. So that's probably a number which I think would be something similar to that, of 30% or thereabouts. Yeah.
So does your investment decisions align with the interest of the investors also?
Yeah. I don't. I mean, like I said, my bulk of my money is in my fund, my own money. I mean, I was a salaried employee. I didn't. So that's all is there in the fund. That has grown to whatever it has grown, but it's still there. I'm not going to be taking it out. And even my colleague, he's put in his hard-earned money into the fund. So we continue. In fact, we actually what we do is that we actually reinvest whatever profits we make back in the fund. So some of that has got added in the last few years because of the pre-investment, but and we have not divested at all. I mean, we've not redeemed at all.
So that last question. So this a bit a personal question that I want to ask you. You started your career as a research analyst. Now you're the founder of a fund house. So if you want to just your journey from research analyst to a founder, so what would it be?
I don't know where to start, but I started research when research came into India. When institutions, when FIs got registered and they started setting up their research houses here. Initially, they started doing research for companies who wanted to raise capital abroad, and then they set up full-fledged research houses by either tying up with local brokers or for running their own team. So I was part of that team in the 1990s. And my colleague also had a very similar career. He joined, of course, he came in 8 to 9 years later, but he had a very similar path in terms of how we progressed. So we did that and we enjoyed it. And there came a time where we felt that we enjoyed the fact that we were looking at companies, we were meeting management, we were doing all of that, but we were not able to invest as such. Not, I mean, certainly not the ones where we had our coverage. So we felt that we should do something on our own and see if we can generate wealth for some of our subscribers, which touch wood we have so far, but a long way to go.
Thank you, sir. So with that, we've come to the end of the session. And of course, there are a lot of questions on the podium. Some were taken, and some we can take it offline as well, and
Sure.
some were already taken during the PPT time. And
Sure.
also in today's webinar, I could we could get a lot of insights on your product, about politics, about market, about sectors, a lot more. Thank you for that, sir.
Not at all. Thanks, Akshay. Thanks for having me, and thank you for PMS. Thank you, PMS Bazaar. Thank you.
Thank you.
Mhm.